Hey guys, Day Worker Night Trader here. I'm here to help you make some money if all the time you can spend is 1 hour a day on the stock market. This video is going to be a more serious one. I have removed my sunglasses for the video today and there won't be any memes. We're just going straight down to business. In the last 1 week, while the market has reached a new high for both SP 500 and NASDAQ, a lot of people have lost a lot of money. All pennies and growth stocks have further declined. In my opinion, there are 3 factors that are causing this. Number 1, capital rotations back to more established stocks across SPY and NASDAQ. Secondly, there's a crypto frenzy that's ongoing right now. This frenzy is driving a lot of speculations and retail capitals from pennies and growth stocks to things like Bitcoin, Coinbase, or even Dogecoin. Lastly, this is a very difficult thing to hear, but your penny stock is likely to be pumped and now is being dumped. It is extremely unlikely for the stock price to go back to the previous high because of the extremely high selling pressure from the previous backholders. Note that the decline of the stock values has nothing to do with the actual performance of the business. The stock may be falling despite the company is able to fulfill all of its promises or even more. This is just the nature of pump and dump. Having said that, today I'm going to be discussing what you should be doing if you got caught in these very situations. Let's just get to it.
I got broads in Atlanta, just to throw me in the family. Credit cards and the scammers, getting the licks in the bank. Legacies.
Personally, I feel that the most important step for you right now is to get out of that sunk cost mentality. And this is a very common thing that happens to all new investors. If you buy a certain stock and the stock happens to dip down in dark red, when you stare at your phone, you stare at your positions and see a dark red positions, you are very hesitant to sell the stock because you keep telling yourself that if you sell the stock, you admit that you are wrong and that amount of money is going to be gone forever, right? And as long as you keep the stock in your portfolio, that's just something comforting with you because you're holding on to the hope that one day it's going to bounce back. When I go to a lot of forums, there are a lot of new investors posting the screenshot of the losses they're experiencing, asking to see whether they should be selling because they think that this is a paper loss. This is not a paper loss. You made the wrong bet. You need to admit that and move on. This is the first step for you to recover. And let me just share with you one personal story. Hopefully it's going to help you quite a lot. The example we are going to talk about today is going to be on Hyliion. So if you remember, last year, Hyliion was one of the most high-profile specs that is hitting the EV market. I was one of the new investors that have heard about Hyliion across the forums, across every single thing. Even my friends tell me about Hyliion. So what happened was that I saw the stock price going up and up and up, similar to a lot of things that you are seeing right now, and I enter here at $45. What happens after that? I was so happy, right? Because at first I see that the investment has been going up and the stock price even go up to somewhere over 55 and closing very close to 60. What happened after that is the disaster. The stock just keep on going down, going down, going down. When the stock started going down, when I started seeing the red, it was a nightmare for me. So I experienced the feeling of anxiety and I keep checking my phone every single minute and see what's going to happen. Day after day, the stock just keep dipping down. And as a new investor, right, this is a very crushing experience for me. I made a decision to sell it, at some point because I told myself that there's a lot of other opportunity in the market. I made the wrong choice. I need to cut loss and I need to sell. The feeling back then, right, wasn't very comfortable. Right? You accept that you lose $30,000. But the interesting thing is that the moment I press the sell button, even though I lose $30,000, immediately after that I feel better, right? Because it's no longer appearing in your phone. It's no longer something that you need to hold, and you stop worrying about losing even more money. And that was the right choice I made. Today, Hyliion is trading at $8.86. If I didn't sell here and I keep on holding for another 5 or 6 months, I will lose another $24,000, and not to mention the opportunity cost from investing the amount of money that's being stuck in Hyliion. After selling Hyliion at a $30,000 loss, I actually used that money, invest somewhere else, and I actually got back 2 times the amount of money that I lose here. A very important lesson for everyone. If you know that you made the wrong bet, just get out. Don't stay in there and lose even more money. Get out of the sunk cost mentality and get ready to cut some losses. For step number 2, if you invest in penny stock and growth stock, you need to understand that it's not just about the business, it's about the valuations of the business. Sometimes for the stock that are being pumped and dumped, the valuations of the company, the market capitalizations at the high stock price is just too high. And the second thing is that as new investors, if you have heard about the stock from a forum, from TV, or from the friends casually telling you, you are late to the party, it's very likely that the stock is already very, very, very overvalued. So understand that it's not just about the business, it's not just about catching the right trend, but it's truly about the valuations. Now the step number 3, if you're new to investment and if you don't understand what the below things are, just get out of penny stock altogether. There are 2 important factors. Number 1, what is the growth projection that the company is having right now? The second thing is that you need to understand the probability that the company is going to fail. And one of the important things to look at is the structure of the balance sheet. Can the company even generate enough cash or survive long enough? If you want to continue to stay in the game, go and really spend some time to learn about income statement, to learn about the balance sheets. Step number 4, in order to not lose more money, you need to start doing your due diligence on the existing stock portfolio that you have had. And you need to keep only the highest conviction stocks and sell everything else. One of the most common mistakes that I see a lot of new investors making today is that they have like 10 to 20 stocks or even more in their portfolio. And the reason why they're buying this stock is that this stock is trending on a certain forum, this stock is trending on the internet, or some of the friends are telling them to buy into the stocks. And this is not the right way to invest. If you feel that you don't have the time to do all this thing, my sincere advice is just get out altogether. Similar to the way previously that I have done, if you get out, you have the money today to invest in something else. And in the next 6 to 7 months, probably you have gotten back the money that you have lost, rather than just biting the bullet and stay in things that you don't understand and lose even more money. So now let me just share with you some of the tips that I have had. And if you see any of the things below that applies to you, probably it's going to give you some good direction in terms of what to do with your existing stocks that you're holding today. So number 1, if you don't understand how the company makes money, get out. There's a lot of people investing online. They just come and ask for a certain ticker symbol of a certain stock and just buy that and hope that the stock is going to grow in the future. Don't do that. You need to understand how the company makes money. The second point is that if you don't understand how the company is better than its competitors, get out. And the reason here is very simple. A lot of penny and growth stocks place the values of the stock today in the future, when the company can eventually grow to a certain size that they can sell a lot of product and make a lot of money. If a competitor get there first, the company you're interested in is going to be driven out of business and the stock price is going to tank. So it's not just about reading the right trend in terms of what industry is going to go well in the future, but it's also about picking the right company. If you don't understand or if you cannot articulate why your company is better than the competitors, get out. The third tip, if your company appears on top stocks on Reddit, trending on Twitters, some certain Facebook group, or some certain billionaires is tweeting about it, that stock is a good trading play, but it's not an investment. I recommend you to get out. Number 4, I understand that there are a lot of stock in your portfolio and possibly you cannot do the due diligence on your own or because you like the experience. My recommendations for you is just go to YouTube or just go to Google, right? Type in something like bear case for your stocks or reservations about, insert your ticker symbol. I learned much more about the companies from the short report and the bear case that the YouTubers are making rather than the bull case, because the bull case is something that other investors or something that a lot of Facebook groups are going to tell you every single day. So more often than not, people are more aware about the bull case versus the bear case. Lastly, I understand that for most penny and growth stocks, the amount of information is very limited, and probably because you have so many stocks in your portfolio, you need to act fast. One of the important things that you can quickly do is that if you're uncertain what the next support level or price point is, just get out. Given the trends recently that you have seen, I foresee that all the penny stock are going to be in pain in the future, at least in the next 2 to 3 months, because SPY is going to still continue to recover. Crypto is not going to end anytime soon. Lastly, May tend to be a very painful month for the stock market. April tend to be a good month, right? Look at SPY and NASDAQ, and you can look at the past 5 years. April tend to be a good month. If you're uncertain what the next support level is, get out. Do your due diligence, and you can still consider to get back in when the stock drop down even further, right? So let me just give you some example of the 2 stocks that I continue to invest in today and I continue to keep in my portfolio. Number 1, NNDM. So NNDM, right, if you invest in penny stock and growth stock, you should know this name. So they're trading at a peak of like $15-ish, and now they're dropping to $7 and some change. For NNDM, they actually have managed to raise $1.5 billion in cash, and the market cap now is standing at $1.82 billion, right? So this means that for every single share that this company they have $6 of cash to back that share up. So it's very unlikely for the stock price to drop below $6. So this only represents about 18% of the downside that we have on NDM. The second stock is CCIV. So they have a level at $15 a share, where all the pipe investment, all the institutions are investing at the price of $15 a share. And now the stock is trading at $19.32. So this represents only a further 23% of the downside. But I'm aware that there's a support at the $15 point. So that's why if you're someone who believes in future of CCIV and Lucid, and you can take another 23% potential downside, and take note that the stock may even go down further, but at least you have a support, right? You can keep staying in CCIV. Now, you need to understand that a lot of penny stock and growth stock don't have any support level. If that's the case, refer to point 1, 2, 3, 4 that I have stated. If any of these things you cannot understand, if you can't get any due diligence on the stock, just get out. Step number 5. After you have narrowed down your portfolio to, let's say, maximum 4 to 5 top penny and growth stocks, number 1, you need to get ready to hold for a very, very long term. The nature of penny and growth stock is that they need to prove themselves before the fundamental values of the company significantly improve, especially after the period of pumping and dumping. And you know the nature of pump and dump. People hardly go back to the same thing twice, and even if they come back in, the high point is hardly the same as the previous high that it has made. So you need to get ready for the long terms because of 2 reasons. Number 1, nature of pump and dump is that the stock hardly go back to the previous high within a short period of time if the fundamentals of the companies don't improve. The second thing is that the fundamental values of the stock only go up if they have proven themselves at the certain stages. For example, when they start to be able to successfully commercialize the product, when they first make the first dollar profit, or when they have made all the commitments and projection in sales, in profit, right? That is typical in the investor presentations. And all these things require a very long period of time, right? So get ready to hold for the long term. The second point is that do not hastily average down just to give yourself some false hope. If I just go back quickly here to the Hyliion example, if you tell yourself that, wow, now it's $25, it can't drop even further, right? Look at where it is today, $8, right? That's why my recommendation is do not hastily average down just to give yourself false hope and make the number nicer. The third point is that if you like the industry and the trend, consider an index fund instead of trying to pick winners within a big bag of companies. For example, if you feel that wheat is something that's going to go up, just find some sort of index fund that track the whole wheat industry. If you like specs, there's an index for that, right? If you like innovation, Arcade is a very good example for you to invest in. Most of the emerging industry and sectors today, we have some sort of indexes that are going to track that. Step number 6, which is also my last steps, you can consider to use option to help you profit from your highest conviction stocks. And I'm going to share with you 2 strategies. Number 1 is going to be to sell covered call, and number 2 to sell cash secure puts. For the purpose of explanation today, I'm going to just share with you very brief explanations on each of this, but the materials on covered call and cash secure puts is readily available on my channel. If the materials on my channel is not sufficient, feel free to just go online and learn more about that, because it's going to help you save money in the long run. So let's talk a bit about covered call strategies. So when you have narrowed down to the top 4 or 5 holdings, you can use these covered call strategies if you are very certain about holding your stock for a long term. Number 2, I'm going to explain to you what a call is. So a call is a type of option to buy a stock at a certain price. This price is called the strike price on a certain date, and this date is called the expiry date. When you sell a call, it means that you earn an amount of money today to agree to sell the stock at the strike price on an expiry date if stock price go above the strike price. Feel free to pause the video over here and just read to digest this. If you still can't understand, let me just go on to the next slide for one example that I have made on this. Let's go through one of the example. And for the purpose of example today, let me just pick an NDM, which is one of my favorite penny stocks. And I believe that some of you have heard about this company or even have personally invested in the company. So let's say today is 18th of April, you have 1,000 stock at the cost basis of $9.50. The stock price today is trading at $7.32, so you're obviously at the loss here, right? Quite a big amount, 20 to 30% losses here. One thing that you can do is that you can sell 10 call expiring on 21st May at a strike price of $10, and you get to collect a premium of $250 today. What this means is that, number one, why you need to sell 10 calls. For one call contract, it's actually covering 100 stocks. If you have 10,000 stocks, you should only sell 10 call contracts, because 10 contracts times 100 is going to equal to 1,000. The second thing is that why you are selling option expiring on 21st of May, I highly recommend you to sell weekly contract if possible. If not, selling a monthly contract. Penny stock is very volatile, right? In 2 months, 3 months, 4 months, 5 months, anything can happen. Now, after you have sold 10 calls expiring on 21st May at the strike price of $10 and premium of $250, what is going to happen? If the stock price doesn't go above $10 by 21st May, it means that you get back your $250 in cash, right? And you can, from here on, sell another contract expiring in June, you get another $250. And just by doing this, right, after periods from 6 to 8 months, you actually slowly getting back your money. Second scenario, if the stock price go above $10, you have to sell an NDM at $10 for a profit, right? Because your cost basis now is only $9.50, and at the same time you still earn $200 a premium from selling calls. Now the question that you might be asking yourself is that, what happens if your cost basis is higher than $9.50? Let's say your cost basis is somewhere in the range of $11. There are 2 things that you can do. Number 1, instead of picking the strike price of $10 here, you can pick the strike price of $12.50, which is the next strike price that is allowed that you can sell the call for this stock. The trade-off is that the premium that you're getting is not going to be $250 for 10 contract. It's going to be something like $120 for this 10 contract. So it takes longer for you to get back your investment, and of course the return month on month is going to be lesser. The second thing is that what you need to look at is if you follow the price of NDM and you know the stock inside out, you would be able to guesstimate and make your own judgment call to see in the next 1 month, would NDM likely to go back to 10, or it would be very likely to shoot past $12.50. Personally, I think that May is going to be another red month. Basically, you should be knowing your industry enough, you should be knowing the company enough, right, to know that in the next 1 to 2 months, whether there's going to be any catalyst that send the stock price upwards. If there is none, feel free to pick a lower strike price so that you can get more premium. But if you know that in the next 1 to 3 months there's going to be some catalyst that is going to send the stock price up, then if that's your case, one of the safer bets is to pick a higher strike price. Lastly, the second strategy is to sell cash secure puts. Since my prediction is that the pain in penny and growth stock is going to continue and extending at least in May, one thing that you can do to mitigate the losses is sell part of the current positions and convert them to cash secure puts. The benefit of doing so is that in the event that the stock price is going down and touching your strike price, you get back your share at a lower price plus the premium. So you're averaging down on the stock that you're highly convicted in at a lower price, right? So that's a first good thing. If the stock price actually go up, or even if it goes slightly down and never touch the strike price, you are still making the money from the put premium. And of course, for the remaining stock that you haven't sold, you can use covered call strategies I have covered previously in order to slowly get back your money. If you need further information on what the cash secure put strategy is, please refer to the video that I'm going to leave in the description box below. And that's it for today, guys. Before we end this video, I just have some of the rules that I have put here for new investors. So number one, don't buy and sell penny stocks if you're new to the market. Penny stocks are only for very advanced traders who understand crowd psychologies and who are very disciplined in terms of the price point that they're getting in, the price point that they're getting out, how much you're going to cut loss and take profit. And it's not the game for the new investors. If you're new and you're getting into penny stock, more often than not, you're going to lose money. Number two, buying and selling penny stock don't teach you the right way to invest. And not only do you lose real money when trading penny stock, but you lose out on the opportunities to properly invest in the long term by picking qualities company, by picking undervalued industry, or simply, to learn the right option strategies in order for you to make consistent money. You need to understand that buying and selling penny stock is not the right way to make money in the long terms for a new and for a typical retail investor. Number three, if you choose to involve, be ready to lose everything and don't use the money that you can afford to lose. Don't gamble your college fund, or don't gamble the money that you need to borrow from the bank or from your families on penny stocks. And lastly, this is a very interesting one. If you hear about it here can be anything, right? From a stock like GME, AMC, or even cryptocurrency, and probably I'm describing the current situation with the Shiba Inu coins as well as the Dogecoin. If you hear about it from your friends, social media, or Reddit, you are probably late to the party, and you need to be very cautious about entering at this point. That's it for today, guys. I hope that this video have helped you, and hope that the situation is going to get better soon. If you feel that this video has helped you, please help to like and subscribe to the channel. See you next time.
Panda. I got broads in Atlanta, just to throw me in the family. Credit cards and the scammers, getting the licks in the